Every single day, over $11 trillion moves through the U.S. stock market, and most people think it's just buyers and sellers finding each other. It isn't. There is a system running underneath every trade you've ever made. You've never seen it, but it sees every order you place. Today, we expose it. Welcome. Today, we're breaking down one of the most powerful and least understood forces in the entire U.S. stock market: market makers. These are not hedge funds. They're not retail investors. They are the invisible middlemen who make it possible for you to buy or sell a stock in less than a second, and they are extracting a fee every single time. Here's the problem that market makers were created to solve. Imagine you want to sell 500 shares of Apple right now. Someone on the other side needs to want to buy exactly 500 shares of Apple at the exact same moment, at the exact same price. For a big stock like Apple, that's easy enough. But what about a smaller company? Or at 7:42 in the morning, before the market even opens? Without a solution, you'd be waiting. The market would be slow, prices would be inconsistent. Trading would feel like eBay, just waiting for someone to bid. This is called an illiquid market, and it's what the entire financial system was trying to escape. Enter the market maker. A market maker is a firm, or more accurately today, an algorithm that is always willing to buy and sell a specific stock or asset at all times. Think of it like a store that never closes. You walk in, you want to buy chips. They have chips. You want to sell chips back. They'll take them. Always open, always ready, always holding inventory. A market maker posts two prices simultaneously: the bid, what they'll pay to buy from you, and the ask, what they'll charge to sell to you. That gap between the two is called the spread, and that is their profit. Let me give you a real example. Say Apple is trading at $189. A market maker might post a bid of $188.96 and an ask of $189.04. You buy, you pay $189.04. You sell, you get $188.96. That 8-cent difference multiplied by millions of shares every single day is a business worth billions of dollars. So who actually does this? 3 names you've probably never heard, but absolutely should know. First, Citadel Securities, not the hedge fund, the market-making arm. On some days, they handle over 27% of all U.S. stock market volume. One firm, 1/4 of the entire market. Second, Virtu Financial, a publicly traded market maker. They reported being profitable on 99% of trading days over a 5-year period. Think about that for a second. Third, Jane Street, privately held, extremely secretive, and known for dominating the ETF market. These firms are not betting on whether stocks go up or down. They don't care. They just want volume. They want you and millions of other traders to keep trading every single day. Here's what's impressive and honestly a little unsettling. Market makers are not gambling. They are engineering. They make fractions of a cent on each trade, but they do it using algorithms operating in microseconds, faster than a human can blink, and they manage their risk constantly. When a market maker buys your 10,000 shares of Tesla, they're now holding inventory. If Tesla drops, they lose money, so they immediately hedge using options, futures, or by offsetting trades elsewhere, staying what's called market neutral. They don't care if Tesla goes up or down. They only care about the spread, over and over and over again. This is why Virtu Financial had just one losing day in 1,238 trading days. It's not luck, it's math. Now, the part that directly affects you. Have you ever wondered how Robinhood is free? Here's the answer: payment for order flow, or PFOF. When you hit buy on Robinhood, your order doesn't go directly to an exchange. It gets routed to a market maker, usually Citadel Securities, who fills the trade. Robinhood gets paid a small fee for sending your orders there. Citadel gets access to your order flow before it hits the open market. This is legal, it is regulated, and it has been controversial for years. Is it bad for you? For small retail trades, probably not significantly. The difference is fractions of a cent. For larger trades, it can matter more. The SEC has been reviewing PFOF for years. Some countries, like the UK, have already banned it entirely. This is the invisible tax that most retail investors never see and never talk about. Here is what I want you to take from this. The market is not random. It is not chaos. It is an engineered system with engineered participants playing engineered roles. Market makers provide something genuinely valuable: liquidity. Because of them, you can buy or sell almost any stock in milliseconds. but they are also extracting value from every single trade you make. That doesn't mean stop trading. It means trade smarter. Use limit orders instead of market orders. You'll often get a better price. Trade liquid stocks where spreads are tight. And understand that there is always someone on the other side of your trade, and they are very, very good at what they do. The more you understand the system, the better you can operate inside of it. Now you see it. If this video helped you understand the market better, hit the like button. It genuinely helps this channel grow. And subscribe for more videos breaking down the systems that move money, explained simply every single week. I'll see you in the next one.